Welcome back. Good Thursday morning, everybody. Thanks so much for joining us this morning. I'm Maria Bartiromo, and it is Thursday, July 16th. It is 7 a.m. on the button on the East Coast. Hope you're having a great morning. We kick it off with the word on Wall Street this hour. Top investors watching your money. Joining me now is the head of U.S. equity trading strategy at Citi, Stuart Kaiser, back with us. Also with us is Mark Tepper here this morning. Stuart, great to see you. Thanks for joining the conversation.
Good morning.
What do you make of markets this morning? We have futures mixed with the Dow Industrials higher, but once again, a little rollover for the semiconductor chips and technology, with the Nasdaq down 178 after all three major indices finished higher yesterday. We had a support for tech yesterday. The Nasdaq was up 162, and you had stocks like Amazon, Alphabet, Microsoft, Apple all contributing to the gains. Apple hit an all-time high, and we are looking at big tech this morning trade higher as well. Even with this rotation out of semiconductors after a two-day rebound, shares of SK Hynix was down 11.5% on the South Korean market. That, of course, dragged down the Kospi index down better than 6% this morning. The selling continues on semis. Your thoughts?
I think on the semiconductors trade, probably just a little bit of exhaustion, over the last month or so. We've also seen, I think, investors ahead of earnings getting a little more positive on those Mag 7 stocks, anticipating them to put up good earnings, also announce a lot of CapEx spending as well. But I think on semiconductors in particular, it's a little bit of exhaustion. We've also had a lot of equity supply hitting the market, which has definitely gotten people's attention. And it's not just equities, it's bonds, it's convertible bonds, it's also stocks, it's the IPOs, it's secondary offerings. And I think, investors are rightfully asking the question of, why are these folks issuing so much stock, and what do I think the return on investment from that is going to be? So
you think with all this stock coming to market, whether it's secondaries or IPOs, is just a supply-demand issue?
Yeah, and we saw this a little bit ahead of the SpaceX IPO. We saw it a little bit ahead of the SK Hynix ADR announcement as well. And the fact is, you need to find money to buy these things. And it also, I think, raises the question of, are these companies telling us that valuation is so high that it's cheaper for them to issue stock than it is to borrow in the bond market? We don't necessarily think that's the case, but it's not an irrational thing for an investor to think about and ask. And I think for that reason, you've had the markets kind of in a little bit of a holding pattern here.
It's a good point to make. Taiwan Semiconductor, meanwhile, announced plans to spend an extra $100 billion on expanding U.S. chip making. They've got 4 new plants, Mark. It brings the company's total domestic investment into the U.S. to $265 billion. Shares of the chipmaker this morning, nonetheless, down 4 2/3% right now on Taiwan Semi.
Stuart, you raised a lot of great points. And I go back to the Marvell moment. What was it, June 2nd, when Jensen Huang came out and said Marvell was going to be the next trillion-dollar company, sitting at, maybe a market cap of $250 billion at that point. I think it went up to about $275. Today, it's sitting at $180, right? So was that the moment where investors are looking at this like, okay, maybe there is a little bit of irrational exuberance. Maybe the bar is a little too high. I mean, earnings growth expectations for tech overall this quarter, I think it were above 60%. Like, for how many consecutive quarters can these tech companies continue to do backflips and somersaults and clear the bar easily? So I think there is some investor exhaustion, right? There's some questions as to whether or not this can continue. However, I will say that what we've seen so far, Maria and Stuart, is that, we have been able to produce, at least good results. But, yeah, I mean, now can companies deliver?
I think that's a great point. If you look at Samsung and Broadcom, both reported in the last 2 to 3 weeks, if you looked at the numbers, you would have said those are very strong reports. The stocks actually traded off a bit. The earnings growth that Mark's talking about, I think what that's like, quote unquote, trickle down economics at this point. It is the large hyperscaler spending a massive amount of money on CapEx, and that's translating into earnings more broadly across the tech complex. So this quarter, frankly, I think those CapEx announcements are key, and we need those to keep that earnings train flowing. And if that earnings train keeps moving, this market's going higher. I don't think there's any doubt about that, but we have to see it.
That is exactly what Brad Gerstner told us recently from Altimeter, and he's looking at the fate of the stock market landing exactly where the spend is in terms of data center build-outs and the AI revenue. Here's what he said. He joined me just last week. Watch this.
What set the markets ablaze earlier this year was Anthropic's revenue and OpenAI's revenue. If AI revenues are showing that we're earning a return on the $1.2 trillion of annual capex that we're now spending on AI, then markets are going higher. If we don't have those revenues, then people will start questioning whether we can afford this $1.2 trillion capex build out. What I'll tell you is the U.S. is ahead of China in AI. The revenues are showing up in May and June for the companies like Anthropic and OpenAI.
But look what IBM said the other day, where IBM executives said that they were seeing a shift in spending, caused the worst day for IBM shares in history.
They're also seeing cybersecurity issues, right? So, I mean, a lot of the cybersecurity stocks were kind of left for dead at the beginning of the year, part of that software apocalypse. But it turns out, as you have more and more AI, like, you actually need more cybersecurity. You know, to what he said, I think the other thing that we need to look at from a metric standpoint is how are the non-AI companies, how are they utilizing AI to drive revenue growth, and how are they utilizing AI to improve margins and improve profitability? Yeah. And that, to me, that is the real end game goal here, is to ensure that AI is helping every company that's not a chip maker, that's not part of the infrastructure build out. How are they helping those companies? And what I'll tell you is revenue growth, again, is expected to be double digits year over year this quarter.
Earnings doing well, a good second quarter beginning, but we got to mention SpaceX.
Oh, yeah.
It is now below its IPO price for the first time. Yesterday, it slipped to just above $132 a share in yesterday's trading, but it is at $135.27 right now. We went public at $135, but of course we know that Anthropic, competitor, meanwhile set to meet with investors. It's preparing for a IPO later on in the year, probably October, ahead of OpenAI's planned debut as well. But overall, I want to get your take on earnings, because we are just beginning the second quarter earnings season with the reports from the major banks, which were higher across the board.
Yeah. I mean, trading revenues up. I mean, you know, you're continuing to see net interest margins improve, which is great. But when we look at these IPOs, you know, SpaceX for me, there's a strong distinction between loving a company and what it's about and loving its valuation.
Yeah.
I respect SpaceX. I think it's a really cool company. I just don't like its valuation.
Well,
so even back down here, like, you know, I would pass on it. But Anthropic, that is one that I would not pass on. That is one that I believe, I mean, their revenue run rate is like 2 to 2.5 times that of SpaceX. Like, the valuation seems very reasonable for what they're going to bring to the table.
Now, you make a great point, because all great companies are not great stocks, right? So let's take a look at the Fed factor here. Interest rates, of course, have been spiking recently, and Federal Reserve Chairman Kevin Warsh on the Hill this week, testifying before the Senate Banking Committee yesterday and the House Financial Services Committee the day before. We had CPI and PPI out, and they were both better than expected, and yet yields are higher, up 2 1/3 basis points on the 10-year at 4.57%. We had declining inflationary numbers. He said it's not enough for sweeping change at the central bank. Here's Kevin Warsh this week. Watch.
In the last couple of days, we've gotten data on the consumer price index, on the producer price index. Any central bank would be happy to have the data going in the right direction. My view is these are all imperfect measures of the state of underlying inflation.
Stuart, your reaction to Warsh this week?
Well, look, I think if I'm Kevin Warsh, I'm very happy. I just walked into an economy that has a 4.2% unemployment rate and has inflation on a downtrend, and I think that gives them a tremendous amount of optionality in terms of how they want to, execute policy over the next, call it 6 to 12 months. And I think that's a good thing for him, and it's a good thing for us and the markets
well,
too.
Mohamed El-Arian yesterday said he's not expecting any moves from the Fed this year, not any cuts and not any hikes either. What are you expecting?
Yeah, I mean, I think that's your most likely outcome, is sort of nothing, which is very interesting, because coming in, the idea was he's going to cut rates for political reasons, quote unquote, and then 2 weeks later, he's going to hike rates because inflation's off the table, and hopefully those things all balance out, and what we just have is a strong economy with moderating inflation, and we could focus on capex spending and earnings growth, and all be happy going into year end.
Yep, I like that. Stuart, great to talk with you this morning. Thank you. Stuart Kaiser. Mark, you're with us all morning. We're so grateful for that. We'll take a break and come right back with the hot topic of the hour. Stay with us.